Welcome back to another session of the Retail Trader Special. Today we are here to talk about how to build a trading mindset. Now I know trading as a field is very lucrative because of course it is the fastest way to make money by doing a business which can be done with very little time if you have the right skill set. But before you even get into acquiring the skill set, which by the way can take a lot of time, there are certain things that you need to ascertain, especially in the mental level, and you need to have a plan. If you want to succeed as a trader, you have to first succeed in your mind. And in this session, I'm going to take you through a step-by-step procedure to how to reach that level, building a trading mindset, understand the basics. For example, what are stocks, what are options, what are futures? I have seen a lot of newcomers in the market enter the stock market to trade options and futures without understanding what is leverage, what are risks, and what are the things that drive the prices. Now, if you don't know basic terminologies like premium and theta and delta, you're definitely not ready to options trade, no matter what people on YouTube may be saying. There are a lot of influencers out there or a lot of content creators out there who say that just sell Nifty when this happens and buy Nifty when that happens and you'll be able to make so much money sure shot. Things do not work like that, and it's not that simple. Before you determine that you want to get into the market full time, you need to understand the basics. It is something that even I had done. Let me tell you how I went through the journey of understanding the basics before I decided to begin a career in the stock market. When I was still in college, I went to St. Xavier's College in Calcutta. There is a career-oriented program called NCCMP. It stands for NSE Certified Capital Market Professional. This was the first thing that I ever studied about the stock market. Of course, I had studied the book of Steve Nissan on candlestick in my 12th standard, but that hadn't helped me learn what I wanted to do in the market and or not I wanted to pursue a career in this. So in order to get a very holistic understanding of the structure of the entire ecosystem of stock market, I opted for the certificate, which by the way, even you can opt for. And yes, it will take some time. It will delay your starting process, but it will make sure that you start on the right footing. It is way better to spend 6 months first, get your basics right, and then start into the stock market with advantage at your side rather than coming to the market, losing all your savings and then taking a few steps back to start again from fresh. The problem is that you will have learned a few things, but now you will need to unlearn those things to again revisit the basics. So first, get through to knowing the basics. Like I said, the best source to do that is attend any course conducted through NSE or NISM, which is super cheap. Next is setting realistic goals. Now, assuming that you've gone through the basics and you understand what it takes to be successful in the stock market, you need to set realistic goals. Setting a goal like I want to earn 10,000 rupees from my investment of 50,000 rupees is not realistic, because in terms of percentage, you need to think, what are you asking from the market? 10,000 rupees on a capital of 50,000 rupees or even 1 lakh rupees is 20% or 10%, which is too much. On an annual basis, that would be like 120%. The best way to judge the reality of stock market performance is by referring to a benchmark. Benchmark can be any index. It can also be a mutual fund, because understand, you can grow your capital by simply investing your money in an index fund. Now, if you decide that you want to engage in active trading, you naturally want to get compensated for the extra effort and energy that you're putting into the market. Basically create alpha. In simpler terms, alpha is the excess return that you generate over the benchmark. In this case, we are referring to Nifty as our benchmark. So if you want to set realistic goals, you need to benchmark your expectations with an index or some mutual fund. It's absolutely also fine to start an SIP in the mutual fund if you are not ready to start active trading in the market. When you set achievable and measurable goals, it will set you on a path to setting bigger and more aggressive goals. But if you set aggressive goals from the beginning, you're only going to face disappointment in the market. The next important point is risk management. Even if you decide to invest in, say, index fund or mutual fund, or if you decide to engage in more safer trade practices like swing trading or momentum trading in the market, that is without the use of leverage, there is still risk involved. So when you go into invest even in a broad benchmark like Nifty 50 using some exchange traded fund or ETF, there is still a risk of losing your capital or a substantial part of your capital, because it is not unheard of or it is not unseen that Nifty has fallen 15, 20, 30% from the peak. We all heard about the COVID crash. So if you're not prepared, or rather if you come to the stock market with capital that affects your standard of living, your risk management will be poor, your biases are going to kick in. And if you don't assess the level of risk in a particular investment vehicle before you invest your money, you will stand to get disappointed. See, the reason why our parents or grandparents majorly depend on the fixed deposit is because the risk is very low there. So when it comes to stock market, especially active trading as a swing trader or a momentum trader, you have to make sure that you stick with the risk reward ratio that suits your goal fulfillment. So personally, when I talk about myself, my goal is to generate 3 to 5% average return in the market every month. Now, this is obviously on average. On some months, I succeed. On some months, I don't succeed. When the market is in my favor, I'm also able to churn out 9% returns on my capital. When the market is not in my favor, my first priority is to manage my risk, reduce the damage to my unrealized profits or my capital. As such, I maintain strict stop losses throughout my investment journey at any stage. And for me, I believe setting my stop losses and trailing my stop loss is the most important activity that I perform, even more important than exiting or entering a stock. Stick to a risk reward ratio. For me, it is 3. That is, I never enter a trade unless the risk reward ratio is a minimum of 3. And I believe following rule over time has brought me as close to the holy grail as I could in the market. Because no matter the market is bearish, choppy or bullish, I am either staying at cost, protecting my capital or making massive sums of money. You need to also understand one reality of the market, that the market is not trending 100% of the times. Even when the market is trending, it may be trending upward, it may be trending downward. And more than 50% of the time, market spends in sideways activity, that is choppy activity. Now, if you're a swing trader or if you aspire to be a swing trader, you need to understand that this choppy or consolidation market is the worst kind of market for swing traders. Because in this, you will get mixed signals, your stop losses will get triggered, you will be tempted to re-enter the stocks, your stop losses will get triggered again. Eats into the capital really fast. Versus when the market is in a trending mode, that is it's bullish or bearish, it is rather easier to analyze and plan our trades, because in a bearish mode, we simply know that we need to sit on capital and wait for confirmations or reversal in the market. When it's bullish, we simply need to be invested in the market where opportunities are lucrative and maintain stop losses. But in the choppy market, everything goes haywire. So have strong risk management and be prepared to follow it to the T. Next is emotional discipline. Now that I was just talking about trends and choppiness and market tops and market bottoms, your emotions play a big role in your success. Of course, all of us have heard about greed and fear, but these are just the extreme ends of the spectrum. When it comes to the stock market, there are other key emotions also that you need to acknowledge and deal with. For example, regret, hope, belief, overconfidence. These are all biases. These are all emotional interference in your trading system as well. If we get too excited from profits booked, that's also bad. If we get too sad, that is also bad. You need to set real goals. Another aspect that I want to cover now is how to view the stock market with respect to your mindset. And this is an example which I often give to my members of the Trade Together program. Trading in the stock market is like getting into a car. Now, obviously, when we travel in a car, we want to get somewhere, or we might be doing it for leisure. But the objective is to get to a destination. For us, that destination in the stock market is making massive profits and growing our capital. However, that destination is a default. Your short-term goal or your immediate mindset should be to protect yourself from risk. Just like when you get into a car, you're not thinking about getting to your destination. Or if you were only thinking about getting to your destination, then you can also drive at the speed of 120 kilometers per hour or 200 kilometers per hour. But do we do that really? We don't. We are not over-aggressive because we know that there is a risk to doing that. Once you sit in the car, you have 3 objectives. 1, make sure that you're going in the right direction. 2, don't hit something. 3, don't get hit by something. As long as you're taking care of these 3 risks, you will get to your destination. The same applies to stock market trading as well. It is very important that you manage your risk properly and you manage your mindset properly. You need to have the right mental approach before you can start thinking about making money and booking profits. In the stock market, even 100 rupees profit is a profit at the end of the day. So if you keep booking profit or making profit your ultimate goal, you will see that you're cutting your profitable positions too soon and holding on to the losers for too long. This is not going to benefit you in any way. So what should be your real goal in the market? It should be to stick to your strategy. In my Trade Together program, I always tell everybody that look at it or think of it like a partnership where you're starting a side business called swing trading. In this, you will churn your capital 3 to 6 times in a year, and you need 2 things to succeed in this. One is proper execution, one is proper analysis. Now, analysis is very skill intensive. That is why you have onboarded an expert, that is myself, to help you with the analysis, and you need to trust me 100. When it comes to execution, you will also get there with my help because I am going to guide you at every step. So this is a mental setup, really helps my members succeed consistently. And if you want to do swing trading, you also need to make sure that you have your risk management, your goal setting, and your emotional discipline on point. I'm not even talking about the basics here because that is basically the foundation of you even getting started in the market. Next is developing a trading plan. Now that you're ready on a mental level, emotional level, and you know your basics, you're ready to manage your risk, you need a trading plan. So trading plan is a terminology that you've obviously heard, but to get into it, you basically need parameters on the basis of which you define your entries in the market, your stop loss trailing in the market, your exit in the market. This is what takes a lot of time, lots of iteration, lots of back and forth in order to build very comprehensively. For me, this is a very ongoing process because even after 12 years in the market, I see that during my process of analysis and chart reading and going over the news in the market, I still learn something new every single day, even from my own trade setup. And I strive to improve my trading plan significantly significantly every time. I will give you an example of what my trading plan looks like. I look at three things. One is price action, one is volume analysis, and one is momentum analysis. Now, in order to do this, I use some indicators, very basic indicators like RSI and exponential moving averages. But within these basic indicators, I have done deep research on multiple time frames to come up with a mathematically logical distribution of the different time frames that I follow. On the basis of these time frames, I have determined certain settings that I apply on my indicators. Now, with combination of this and with a combination of using volume on a MACD basis, comparing 20 days average volume to 100 days average volume, I have seen that I'm able to enter and exit stocks, rather enter stocks almost right at the bottom. Of course, I'm still working on exiting my stocks at a better position, but this has been helping me in trailing my stop losses. So when you get into trading, have an initial plan and then don't change or rejig it entirely. Keep making small improvements over time and you will get a lot further in a matter of just 2 years than you will in a matter of 10 years if you don't keep some sort of consistency in your trading plan or don't have a trading plan at all. Listening to analysts on TV or YouTubers or even us on Economic Times platform here is not a good idea for picking stocks and investing your capital. You need to have your own skin in the game. If you are taking advice from somebody, make sure you're taking it one-on-one, because when someone comes on TV and gives you an advice, if you cannot approach them again for a follow-up analysis once the stock market action has unfolded, the advice is absolutely no good for you. It is total garbage. In fact, it's a hellhole for your money. You're going to lose a lot of capital. Then, like I already said, you need to continuously adapt, continuously learn. So what is happening in the market? For example, unfolding of the big pandemic, unfolding of wars, government policies. Where is the government directing its funding? Where is the government easing regulations, reducing tariffs, reducing rates, providing subsidies? These things impact stocks, impact sectors, and impact portfolio. I have seen a lot of people be very attractive to stocks like Wedl, stocks like Adanta. They have a lot of retail interest because they are so volatile. But you need to understand that these stocks being volatile are also super risky. A stock giving you huge dividends but not having a great business, not having good corporate governance, having integrity issues, being fined by the regulator is not a good idea. When you trade in the stock market, you have to make sure that at least the basic hygiene is in place, which is the fundamentals of the stock are at least good. Then on top of that, you trade on that particular stock to make money, because at the end of the day, there is also market risk to throw you off your game. Now, understand leverage and its risk. This is specifically for people interested in options trading and who engage in options trading but don't understand leverage. When you use leverage, you increase your risk, not only your reward. Most of the people think about the reward part of it, but not the risk part of it. Now, for example, in options, you will see that within a day, it's very common for options to move 100%, 200%, even 1000% in a day. This also works the other way around. Especially if you're selling an option, there is a good chance that the stock price declines massively and the premium that you have already sold increases, which means you're going to have to buy it back at an infinite amount, potentially infinite amount higher than what you have paid. That is a huge risk that you're taking. Recently, in fact, SEBI has also limited shorting of securities to an extent, because a lot of people were engaging in that without garnering a full understanding of the risks involved there. So if you're doing leverage trading or options trading, you need to know first the risks of leverage, how leverage affects your profit and loss, how it affects the price of the instrument that you're trading in, and most importantly, make sure that you go back to your contract note and understand how much you're paying to participate in this kind of trading, because the leverage that you're taking does not come for free. There is a major cost element which you need to analyze and track religiously, because if you don't, you will realize that even if you're in 25% profits, you barely get anything to take home because the costs you have incurred are massive on that. So please be very mindful if you are somebody who uses leverage. Using technology and tools. Now, if you want to be a good trader, you have to be smart about it. Use a premium charting tool if you depend on price action analysis like me. Use good trackers, maybe a simple Google Sheet, an Excel, or even online trackers like Money Control provides you something. Stockage is providing you a tracker. Use some sort of tool. I personally prefer Google Sheets because it gives me a lot of flexibility with terms of improvements. And over the last many years, I have been in the continuous process of building my own trade tracker, which I have also created a simpler version for my members of the Trade Together program. I also use tools like GTT, that is Good Till Trigger on Zerodha, to set my stop loss and targets, because sometimes in the stock market there are a lot of freak trades, and even if whiplash happens and my stop loss gets triggered, I have the option of re-entering the stock. I am absolutely fine missing a half or 1% on a swing trade rather than taking the huge risk of not setting the stop loss at all. In fact, I have completely stopped trading with brokers that do not give overnight stop loss positions, and I recommend all the members of my Trade Together program also to do the same, because if there is technology available, you need to start utilizing it for your own benefit. Networking and community engagement. This is a two-edged sword. There are benefits of networking in community, but there are also downsides. The benefits are that if you join a community which has high quality analysis being presented to you, you benefit from it. But the biggest problem with most community is that after they garner some level of visibility, the quality of input really reduces. The reason is that once maturity hits, or once 20,000-30,000 followers or members have become part of a community, you will often see that the inputs are no longer being shared by the senior analysts, rather by junior hires. Because of this, the quality is really bad and unreliable. However, the legacy which was set by the time 20,000-30,000 followers were forged remains. Because of this, the new joiners really get impacted. So if you want to join a community, join a relatively newer community, you can directly relate with the analyst who's talking or believe in the methodologies which are being presented to you. On this note, I also have a community on Telegram where I communicate with very serious investors and serious retail traders. I will drop the link of that in the comment if you're interested to join my community. The next point that I want to discuss is having healthy trading habits. Healthy trading habits is just like any other habits. Like if I say healthy teeth habit, you think about brushing your teeth. Now, healthy trading habit is nothing but maintaining your trade tracker. So every night before going to bed, you should know what has happened in your trading account and how that impacts you, whether or not you have stop losses set. So I, as a matter of discipline, make sure that after every day in the market, I spend at least 30 minutes updating all the trades that have occurred during the market in my trade tracker. Go back in my trade tracker, see whether stop losses need to be revised or new stocks have been added and stop losses need to be set, and I set them up. For most of my trades, I set my stop loss immediately as soon as my position is created. And then in my trade tracker, I update the level of the stop loss also. So during the day, I have this habit of never looking at my holding statement. Why? Because my holding statement is only going to tell me about the profit and loss. Instead, I look at my trade tracker. Why? Because in my trade tracker, I can see how much a stock has moved during the day. On the basis of that, I know how far my stop loss is from the current market price. I don't want to maintain a more than a 5% stop loss unless the stock personality warrants it. If I see that my allocation is very small in a certain stock and it's starting to look attractive, I'll go ahead and purchase more of that stock in my portfolio. So the trade tracker being meticulously maintained is now becoming a partner who tells me what I need to do when I need to do. Not only this, the trade tracker habit that I have developed over the last few years also helps me become a better trader. And how is that? Every few weeks or on a continuous basis, I run some filters, especially after the market, on the closed trades. So suppose the market is topping out and I want to know what are the mistakes that I am culpable to commit in a topping out market. What I will do is I will look at the past market tops and I will filter out the trades that were closed or opened around this time and study those trades. Now within these trades, I can again study the stocks that are ended in profit, that ended in losses. This gives me a very good idea of the kind of mistakes that I'm capable of committing. When you start with the stock market, once you're through with the basics that we discussed in the first slide, once you're through with the basic knowledge, it's really all about building what you have learned on top of one another. You don't need to learn new strategies every day. You don't need to learn new approaches every day. You need to strengthen what you have already learned and you need to build on top of each other. That can only be done with discipline and commitment. When you have discipline, you have habits. When you have commitment, progress and compounding effect. Evaluation of performance and making adjustments. We've just discussed that. The habit of maintaining your trade tracker is going to help you evaluate your performance better. And if you evaluate your performance properly, especially after some time has passed since your trade closed, because by now your emotions have dissipated, you will be able to make proper adjustments to your trades to become a better trader, get better results, make more profits in the process. With that, I have discussed everything that I wanted to discuss with you. Now it's time for Q&A. So if you have questions for me, feel free to put them down in the comment section. Tell me the name of the stock and the average cost, and I will tell you what your stop loss should be, what your target should be, and what your actionable advice with respect to hold, exit, or add more should be for a particular stock. I also give services of portfolio cleanup where I can create a whole report for you. If you're interested to know more about that, join my Telegram channel. If you also have any questions about the session that we just discussed, feel free to ask in the comment. Now, while the comments get populated, I want to tell you a little bit about my Trade Together program. The ET moderator has already pasted the link of the Gap Up platform where I am listed as a SEBI registered research analyst. And through that elite plan, I help members engage in swing trading, where I tell you which stock to buy, when to buy, at how much to buy, and how much of a stock to buy in your portfolio in a percentage term, and help you with updates of trailing stop loss, exit, or re-entry if warranted. So we have a first comment, and it is about Jubilant Foodworks. So let's take a look at the chart. I was quite bullish on this trend to continue from right here because the stock was consolidating near the 200 EMA. But from what I can see, the negative divergence on the 75-minute time frame has played out a deeper impact than what I was expecting, or rather it has unhinged the 200 EMA support. Now the stock is headed further lower. However, what I also sense is that this downtrend that we are seeing, it does not have a lot of volume support, which means that there is a pretty good chance that the uptrend will continue. But before the uptrend continues, we need to wait for the momentum to stabilize. And just today in my Telegram channel also, I posted my market comment in which I have observed that all the way from 3-minute, 15-minute and 75-minute time frame, we are seeing signs of weakness. So right now the Nifty has closed right at the support level I've suggested, 21,500. Now in the coming couple days, if that support level gets breached with a closing basis, then the problem is that we can see the level of 20,200 get revisited, and we might not see the level of 22,000 come. So the market is expected to be very choppy, very dangerous. So please be sure that you maintain stop losses. And as for this stock, I am waiting for the level of around 520 to come back before I make a potential re-entry. And if you're having a long position right now, I would suggest you to maintain your stop loss at the level of. Small reminder from the ET moderator, if you're enjoying this live stream, please don't forget to give your thumbs up, because your like, your comments and your engagement helps take this video to more viewers who could benefit from the knowledge that I have shared. DCB Bank, fresh entry, long-term view. The stock is standing at strong resistance from the trend line. The volume activity is pretty strong and promising. Daily chart is very strong, and I can see the stock has just bounced up from the 500 EMA, which is also promising. On the 75-minute time frame, I can see some sign of exhaustion in the volume. So if you wish to make a fresh entry, I suggest you wait for at least the 200 EMA of the 15-minute time frame to come. So if you use TradingView, you can set an alert, change the condition to the name of the stock, and the keep crossing is crossing, and instead of price, select 200 EMA. So what this does is this will set an alert for you that when the price of 15-minute time frame comes to the 200 EMA, you will get an alert about it, and then you can do the analysis of whether you want to go long in the stock or not. Piramal Pharma for Gotham. If you have more queries which don't get answered during this live session, feel free to join my Telegram channel and ask me your queries on Telegram. I can see that there was a massive turnaround in the stock, and now the stock seems pretty set in terms of the bull trend that is unfolding in this. Here the volume is pretty strong and some consolidation can be seen, but the consolidation also has a positive bias to it, which is very encouraging. And I can see that the stock is coming down, showing some mean reversion to come back to the 200 EMA. I believe that the underlying trend is very strong. And in the last few sessions, I've been saying, especially in the Market Outlook series, that the pharma sector and healthcare sector is looking super strong. So I think this stock is one that is probably set for success. So what you can do is see the next resistance is here, which if I tell you in a percentage terms, at least 10% upside. So you can set a stop loss on the stock somewhere around the level of 136, which would give you a 4.5% stop loss. But then again, this target of this trend line at the level of 160, I think is a very conservative target. And I would expect the stock, when it starts to basically move up again, retest this high. Because if you see, if I can just draw a few more of these zones, you will see that the stock is clearly taking resistance every time one of the previous peaks gets reached. So now that this resistance has been crossed, I would expect the stock to rally all the way to 170, which would give a very attractive 20% upside target on Piramal Pharma, Patel Engineering. So this is a pretty good stock, and there is a very strong up with telltale volumes unfolding. My problem with the stock is the volumes are not very high in this, and it's a little bit illiquid, which is the reason why I personally don't actively trade. Now I can also see that the stock has started forming higher highs. In fact, it's just forged. So what I will do is I'm going to start drawing bullish trend lines on this, because we can clearly see the bottoms have also been forged, and we will let the bearish trend lines remain on the chart. I would strongly recommend that you invest for the long term, not the short term. And right here, I can also see that the stock has braved the 500 EMA of the weekly time frame, which is quite significant, and it has done so with strong volumes. So from a long term perspective, if you were to purchase this stock, unfortunately, your minimum stop loss will have to be 25%. And on the upside, however, your target can be as high as 90%. But again, I will emphasize the stock is not suitable for short-term trading. It is good for long-term investing. Let's take a look at LIC, which a guest audience member has bought at the level of 680. So taking a look at LIC now with a purchase price of 680. So with 680, you are in pretty good profits. And as you can see, the underlying trend of LIC has been pretty strong. but I think LIC has run its course for now. So I personally also had a long position, full disclosure, until very recently in LIC, which I have exited almost at the top, because I can see that the RSI has forged a massive negative divergence, which is the first sign of a potential bearish range shift in the momentum, which means that the momentum is signaling that the price can go into a bearish trend. So we don't want to hold on to a stock where the momentum is suggesting bearishness, because remember, the momentum is a leading indicator. So with respect to this stock, since you are already in pretty good profits in 680, I would suggest that, if you listen to me, I would suggest you exit and you book your profit. But if you are very bullish personally, like on your own, you can go forward, continue to hold the stock with a stop loss at the level of 775. So for Manish, let's take a look at Trident. Very strong, beautiful rally unfolding in this stock. I can see that the stock has come onto a resistance. See, the volume activity suggesting that the bull trend that is unfolding on the stock is super strong. So it is expected to continue. But if you want to make a fresh entry here, especially with a target of around 57 rupees, which is, by the way, a pretty massive target on the stock, you want to wait for the stock to cool down at least a little bit. Now, in this stock, I wouldn't expect a proper mean reversion back to the 2 EMA to happen, because that's like 8% away. However, I would want to wait for the RSI on the 15-minute time frame to come back to the level of maybe 50, 55 to make a fresh entry. TVS Supply Chain Solutions Limited. I right now don't see a discernible trend unfolding or signs of positivity here as such. So I don't think it's a good stock to touch or get into. You want to get into stocks which have proven their mettle, because you need to love your capital more and not risk it in stocks which clearly are massive bear trend. Angel One Limited, average price. Angel One. 2900, so very good entry, and the stock is already in 30% profit. So for you, the priority is naturally to make sure that you don't lose this profit, that is maintain stop loss. And given how strong the uptrend is, I would suggest please maintain a stop loss at the level of 35.40 or 7.5% roughly from the current market price. Let's take a look at Bandhan Bank. I am personally not very bullish on banking sector. I have my own biases, you can say, in a way against it, but what I am seeing in Bandhan Bank is really disturbing, because there is a which has started with a very strong volume. Strong participation in a downtrend is never a good sign for a stock. This basically indicates that downside can continue. Also, if you check out the daily chart like I'm seeing here, the 500 EMA is acting as a massive resistance for the stock. I would expect Bandhan Bank to fall as low as 205. If you're holding the stock, I suggest you get out of it first thing in the morning tomorrow. So with that, we've come to the end of this session. And if your stock queries have gone unanswered, there are two options for you. One, you join my Telegram channel, and two, you join me again in the next live session on Wednesday, same time, same place. So I will see you again on Wednesday at 5 p.m. in my Let's Get Technical series, where I bring to you one stock and I do a detailed, in-depth analysis to show you my reasons for participating in the stock and the performance that is unfolded after. So I'll see you again on Wednesday. Thank you so much for giving me your time, and namaste.